just had your best year ever. Then your accountant did exactly what you pay them to do. And by April, you look broke on paper. Now you want to buy a house. I'm Ron Siegel, certified liability advisor, helping families build wealth through strategic debt management. Self-employment reshaped how millions of Americans earn a living. Independent contractors, freelancers, small business owners, gig workers, real estate agents, consultants, rideshare drivers. The W-2 paycheck is no longer the default, and that shift happened faster than the mortgage industry moved. Here's the friction. Conventional underwriting leans almost entirely on tax returns and W-2s. Your tax return is designed to show the lowest legal income. Your business is designed to produce the highest real cash flow. Those two goals point in opposite directions, and the mortgage sits right in the middle. That's the gap a 1099 loan was built to close. A 1099 loan is simply a mortgage program designed for borrowers whose income shows up on IRS Form 1099 instead of a W-2. Anyone receiving non-employee compensation. Instead of forcing your file through a W-2 shaped hole, it documents income the way you actually earn it. There are three main flavors, and they are not interchangeable. First, bank statement loans. These use 12 to 24 months of personal or business deposits to build your qualifying income. If you have steady deposits and heavy write-offs, this is usually the one. Second, profit and loss programs. A CPA-prepared profit and loss statement carries the weight, often prepared with bank statements to verify it. Good for a business with clean books and a real accountant behind them. Third, asset depletion. This one counts your liquid assets as a source of qualifying income. It works well for a retiree or someone with substantial savings and modest current earnings. Each of those programs sets its own minimums for credit score, cash reserves, and time in business. So the right fit is not a preference. It depends on your full financial picture. Let me put a number on why this matters. Here's an example. A contractor runs $240,000 through the business in a year. That is $20,000 a month landing in deposits. After every legitimate write-off, the tax return shows $96,000. That's $8,000 a month. Conventional underwriting looks at $8,000 a month and stops there. A bank statement program looks at 24 months of deposits, applies an expense factor, and lands closer to $10,000 a month of qualifying income. That's $2,000 a month difference at 43% debt-to-income ratio. $2,000 a month of extra income adds roughly $860 a month of housing capacity. Depending on the rate and the term, $860 a month is often the difference between a loan amount near $510,000 and a loan amount near $645,000. Same person, same business, same deposit, same credit, different documentation. So what does this mean for you? It means the process looks different, and you should walk in expecting that. Most lenders will still ask for 2 years of personal and business tax returns, recent bank statements, a current profit and loss statement, and possibly a balance sheet or business license. You'll hand over more paperwork than your W-2 neighbor does, and there is no way around that. You should also be ready to explain your deposits. If $40,000 showed up in 1 week, underwriting will ask what it is. What was it for? That's not suspicion. That's the job. A borrower can answer those questions in an hour, closes weeks faster than a borrower cannot. A few things you can do right now that cost nothing. Keep your business account and your personal account separate. Stop moving money between accounts in the 90 days before you apply. Keep a short note on any deposit that is not ordinary revenue, and get your profit and loss statement current instead of 7 months stale. Now, here's the part I care most about, and is where a certified liability advisor earns the title. Eligibility and suitability are not the same word. You may be eligible for 3 different programs. You're probably only suited for one. Bank statement pricing is generally higher than conventional, not by a lot, but they are a little bit higher. Asset depletion burns through documentation of your savings. A profit and loss program only works if your books can survive a look. Picking the one that fits your household, your reserves, your 5-year plan is a different conversation than picking the one you happen to qualify for. And this is why I say it every single week. Strategy beats rate always. I watch self-employed buyers chase the lowest advertised rate on the program they can never document. then get to decline 30 days into escrow with the earnest money on the line. A program that closes beats a rate that does not. Strategy beats rate always. One more thing for the realtors listening and for anyone about to sell a house. A 1099 buyer is not a weaker buyer. These programs are widely available now, and they close when a self-employed buyer comes in with a real pre-approval from a lender who knows the space. That offer deserves the same respect as any other. Do not throw it out because the income section looks unusual. So where do you start? Start with your own numbers, then get certified before you shop. Go to rsrlinks.com/certified buyer. That's rsrlinks.com/certified buyer. We review your income, your documentation, your credit up front, so you know which program fits, and a seller is not guessing about whether a self-employed buyer can actually close. For a 1099 borrower, being organized is not a nice touch. It is the whole approval. Go to rsrlinks.com/certified buyer and get that handled before you start looking at houses. If you're self-employed and you have been told no, or you assume the answer was no and never asked, reach out. A short review of your income and your documentation will tell you which door is actually opened. I am Ron Siegel, certified liability advisor, helping families build wealth through strategic debt management. Thanks for listening to Mortgage 101, brought to you by rsrloans.com, rsrloans.com, free.